It was the year 1982, and one prediction broke all the eggs in the bucket, as this guy told every major CEO in America what was about to happen to the economy. But things took the other turn. And then the clients disappeared overnight and the million-dollar business collapsed completely. You won't believe the same man who'd been advising billion-dollar companies had to call his dad and borrow $4,000 just to pay rent. Now, what was the inner story? What went wrong? And what did he discover in that failure? This is the story of Ray Dalio and the collapse that nearly ended him. So here's what you need to understand first. Ray Dalio wasn't some random trader making wild guesses. By the early 1980s, he'd already built something real. He'd left his corporate job and started Bridgewater Associates from his tiny New York apartment in 1975 and was steadily growing a reputation. He was advising clients on currencies and interest rates, and people were listening. However, between 1979 and 1982, Dalio became convinced of something big. He believed a massive global debt crisis was coming, and it would trigger a depression like we hadn't seen since the 1930s. Now you might be thinking, was he just being paranoid? But I mean, his logic actually made sense at the time. You see, the American banks had loaned out enormous sums to foreign governments. We're talking about hundreds of billions of dollars to countries that realistically couldn't pay it back. By 1982, Latin American nations alone owed over $327 billion to US banks. Mexico was sitting on $80 billion in debt, with $20 to $30 billion owed directly to American institutions. Dalio looked at these numbers and thought, this is a ticking time bomb, and it's time to cash this opportunity. But this is where things got interesting. Dalio went all in on his prediction. He appeared on Wall Street Week with Louis Ruckesser, one of the most watched financial shows at the time. He wrote newspaper columns. He even testified before Congress, warning lawmakers directly that American financial system was on the verge of collapse. That takes guts, or maybe overconfidence. And here's what made it all seem so right at first. In 1982, Mexico dropped the bombshell. They announced they couldn't repay their $80 billion debt. Dalio later admitted, when Mexico defaulted in 1982, I was sure I was right. This was it. The confirmation he'd been waiting for. The crisis was here, except it wasn't. Just when Dalio thought he'd proven right, the Federal Reserve made a move that changed everything. Paul Volcker, the Fed chairman, pivoted hard. Instead of continuing tight monetary policy, the Fed started cutting interest rates and pumping money into the system. But, markets didn't crash, they started rising up. One of the biggest post-war rallies in history kicked off, and Ray Dalio was positioned for the exact opposite. He'd bet big on rising interest rates and falling stocks. He'd placed massive trades expecting doom, but the market went up, like way up. And that's where you should keep watching, as things got pretty bad here. Dalio lost money, both his own and his clients'. Bridgewater, which had been steadily growing, collapsed almost overnight. He had to fire nearly every single employee. At one point, it was just him, alone in the office, staring at the wreckage of what he'd built. He was so broke that he had to call his father and ask for $4,000 just to keep himself afloat. Think about that. This is a guy who'd been on TV predicting the future of the economy, who advised major corporations, who had testified before Congress, and now he couldn't even cover his own expenses. He later described it as feeling like a baseball bat to the head. But you know what? Most people would have walked away, shut down Bridgewater, maybe they got a regular job somewhere, licked their wounds and moved on. And Dalio almost did. He later told institutional investors that 1982 was my abyss, that he seriously considered closing the firm to provide for his family in more stable ways. But something shifted there. Instead of seeing this as the end, he began to see it as information. Raw, painful, expensive information, but information nonetheless. I would name it the major turning point. Dalio realized his biggest mistake wasn't the prediction itself. It was his certainty, his ego, his belief that he couldn't be wrong. He completely rebuilt his approach from the ground up. He started writing down principles for how to invest and how to manage. He took his ego out of decision making and created systems. He built what would eventually become Bridgewater's famous culture of radical transparency and idea meritocracy. And the biggest change was diversification. Instead of making big concentrated bets like before, he developed a new strategy. He broke down risk into multiple uncorrelated baskets, eventually creating about 15 separate return streams that had minimal correlation to each other but similar expected returns. The goal was to reduce portfolio risk by up to 80% without sacrificing returns. This became the foundation for Bridgewater's famous all-weather and pure alpha funds. It was a complete 180 from the trader who'd bet everything on one big call. And slowly, steadily, it started working for him. By the mid-1980s, Bridgewater stabilized. New clients started coming in, attracted by this disciplined, systematic approach to risk management. Through the 1990s and 2000s, the firm exploded in growth. Here's where the numbers get wild. Over the next 30 years after the crash, Bridgewater averaged annual returns of about 11.8%. They had only a handful of losing years during the entire period. The firm went from managing nothing to tens of billions and over $100 billion, becoming the largest hedge fund in the world by the 2010s. Even by the end of 2025, after Dalio stepped away from the active management, Bridgewater was still managing over $92 billion in assets. Now, here's what's interesting about how this story gets told today. The financial media absolutely loves the narrative. You'll see headlines like "From broke to billionaire" or "The $4,000 loan that built a hedge fund empire." Bloomberg, Fortune, CNBC, and Business Insider, they'll all frame it the same way because it's the perfect redemption story. Publications like Fortune have quoted Dalio saying things like, "This was painful, but it changed everything." So what can we take from all this? First, certainty is dangerous. The moment Dalio thought he couldn't be wrong was the moment he was most vulnerable. Even the smartest people with the best data can miss the mark when they stop questioning themselves. Second, systems beat emotions. After 1982, Dalio stopped trading on gut instinct and started building systematic processes. That shift from emotional to mechanical decision-making is what saved him. Third, diversification isn't just theory. Spreading risk across uncorrelated assets isn't boring, it's survival. Dalio's 15 baskets approach literally reduced his risk by 80%. That's not small, that's game-changing. And finally, failure is only permitted if you quit. Dalio was 33 years old when this happened. He could have walked away. Instead, he used it as a foundation. 1982 should have ended him. Instead, it made him. That $4,000 loan became a $160 billion empire. The failure became the foundation. And that's exactly how your worst moment might be your biggest breakthrough. That's it for today's video, guys. Please subscribe to the channel so you can watch amazing videos like this each week.